Hey everyone, welcome back. Today we're going to talk about something that might not grab headlines the way AI or crypto stories do. But for investors thinking long term, it's quietly making waves. I'm talking about the SCHD ETF, Schwab's U.S. Dividend Equity Fund. Now, at first glance, a dividend-focused ETF might sound a little boring, right? But stick with me because this fund is demonstrating how steady, defensive investing can outperform during periods of uncertainty and market turbulence. We're going to explore what's happening with SCHD right now, why it's outperforming other ETFs, and what makes it an interesting choice for investors who want income, stability, and long-term growth. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. As of February 6th, SCHD is trading at $31.39. Throughout the day, it fluctuated in a tight range between $31.06 and $31.40, exactly hitting its 52-week high. If we look at the fund's year-long performance, it's moved between $23.88 and $31.40. So the fund is trading roughly 31% above its yearly low and sitting right at the top of that range. That's significant because the price isn't just moving randomly, it's anchored to a complex macroeconomic backdrop, which we'll break down. The global environment is full of uncertainty. Just last month, the U.S. conducted a military operation in Venezuela. In Washington, discussions about potential action in Iran are ongoing. Meanwhile, Chinese military exercises are happening near Taiwan, and the Russia-Ukraine war is approaching its 4th anniversary. Add to that U.S. domestic political uncertainty and an upcoming Federal Reserve chair transition, and you have a cocktail of risks that make investors cautious. At the same time, the AI and tech sector is committing enormous capital spending for 2026, hundreds of billions of dollars into data centers and AI infrastructure. That level of investment is so large it's been compared to the GDP of a major country. This type of spending naturally pressures forward returns because depreciation and amortization for these assets ramp up faster than most models predicted. Capital tends to respond mechanically in situations like this. Riskier growth assets, those tied to long-duration returns, are under pressure while defensive, income-oriented assets are attracting demand. For instance, gold is outperforming the stock market on a year-to-date basis despite a small recent dip. Bitcoin and Ethereum are both down more than 25% since the start of 2026. Against this backdrop, SCHD, with about a 13% gain year-to-date and sitting at the top of its range, is clearly benefiting from a rotation of capital into defensive income, rather than just drifting higher without reason. Looking at price performance from early November 2025 to early February 2026, SCHD delivered roughly 17.53% total return. Compare that to a broad S&P 500 equal-weight ETF like RSP, which gained only about 6.51% in the same period. SPY, which tracks the broader market, was essentially flat at 0.15%, and QQQ, dominated by tech stocks, fell around 4.79%. That means SCHD outperformed SPY by nearly 18 percentage points and QQQ by more than 22 points in just 3 months. That's a huge gap, and it tells you a lot about the current market rotation. Scale amplifies this effect. SCHD manages around $80 billion in assets under management, making it one of the largest dividend-focused ETFs in the U.S. Every 1% of capital flowing from growth into SCHD represents around $800 million. A 5% shift across institutional portfolios could involve billions. With a share price near $31.39, an average daily trading volume of about 3.08 million shares, roughly $96 to $100 million changes hands each day. That liquidity profile is precisely why large allocators are using SCHD as the defensive dividend component of their portfolios. Year-to-date, the price momentum tells the same story. While large-cap AI companies have dropped double digits from their peaks, SCHD is up about 13% since the start of 2026. This isn't an accident. It reflects systematic capital outflows from high multiple growth stocks into equities offering stable cash yields backed by mature businesses. The reason for SCHD's defensive performance is visible when we look at its sector weights. Technology represents less than 10% of the fund. In contrast, other dividend ETFs like VIG have over 27% in tech, and VYM has more than 16%. That means SCHD has far less exposure to the companies driving extreme growth and volatility, while maintaining solid allocations to more defensive sectors like energy, healthcare, and consumer staples. These sectors dominate SCHD in a way that they do not in its peers. Energy, healthcare, and consumer staples tend to generate cash flows tied to real, tangible assets, basic consumption, or regulated industries. That contrasts with companies whose valuations depend heavily on aggressive AI growth assumptions. So when AI-linked stocks are dropping 15 to 20% from their highs, SCHD's lower tech exposure and higher defensive weight help it outperform both the broad market and other dividend ETF. Income is another big part of the story. SCHD currently offers a 30-day SEC yield of about 3.5 to 3.65%, combined with 3-year dividend growth of roughly 7%. This means investors not only receive steady income, but can also expect that income to grow year after year, which is why many treat SCHD as a sort of bond substitute. Compare this to traditional bonds like BND, which yields about 3.88% but has produced virtually no nominal return since mid-2020. Once inflation is factored in, the real return of bonds has been deeply negative. U.S. CPI has tracked above pre-2020 trends, and the bond market saw one of its worst drawdowns in decades in 2022. For many investors, it's more attractive to earn a 3.5% yield in equities with 5 to 7% growth potential than a fixed coupon vulnerable to inflation. When comparing dividend ETFs, the pattern is clear. Higher yields correlate with higher recent returns. SCHD, with about a 3.5% yield, returned 17.53% IDV, yielding 4.45%, returned 15.23%. DGRO at 2.14% returned 8.2%. RSP at 1.62% returned 6.51%. SPY was flat and QQQ lost nearly 5%. SCHD sits in the middle, offering enough yield to matter while maintaining controlled risk. SCHD holds around 100 stocks, while VYM has 564 and VIG has 339. This concentration gives SCHD the potential to outperform when top holdings are strong, but also increases vulnerability. For example, if a top 10 holding representing 4 to 5% of the portfolio drops 20%, the ETF immediately suffers an almost 1% decline. In a fund with hundreds of holdings, the same drop would have a far smaller effect. Valuation-wise, many top holdings are trading near consensus price targets. Forward peg ratios cluster near or above sector medians. That tells us that SCHD isn't finding massive bargains. It's benefiting from factor flows and sentiment layered on solid, fully valued companies. At $31.39, SCHD is a mature income-focused fund riding current market rotations, not a deep value play. So, to wrap it up, SCHD isn't flashy, but that's exactly why it works in the current market environment. It's sitting at its 52-week high, outperforming major indexes, and absorbing capital flows from investors rotating out of high multiple growth into defensive income-producing assets. Its sector composition, yield, and concentration profile make it a practical vehicle for long-term stability while still providing meaningful returns. If you're looking for a way to balance your portfolio with income and stability in an uncertain world, SCHD is worth a closer look. It's not about chasing the next tech craze, it's about steady, measured performance in a world that's anything but steady. Thanks for watching! If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.